All right, today I want to dive a little bit deeper into a concept from Richer, Wiser, Happier, and it's the two parts of return. The first part of return is the growth of the company, where in the book it often talks about the intrinsic value of companies, and that the intrinsic value is based upon the true financials of the company, the revenues, the earnings, all the financials that make up what would be a fair value to buy and own the stock at. The second is the price convergence to its intrinsic value. So much of the book is about how do you buy stock at a discount that are solid companies. Now, if you were to buy a stock at a discount, then you actually not only get the growth of the company, but if it converts back to its intrinsic value, you get to have that gap too. Easiest way to understand this is through an example. I made an example on Apple. I don't get too tied into the exact numbers. I just wanted to showcase 5 different price points. I took this July 13th when Apple was at $208. A couple of things just to take note at. If you look back over the course of not quite the 5 years, but the price return on Apple is 90% versus the intrinsic value return or growth of intrinsic value is only 41%. So in today's terms, we are overvalued based upon those calculations. So let's just say you bought in September 2020. Well, you were bought at a fair price at $109. And depending upon where you sold it, you're getting the rate of return of the intrinsic value. If you sold it here, you got a higher rate of return. Here, higher rate of return. Here, higher rate of return. So you got the growth of the company, but you also got the higher rate of returns of the intrinsic value. If you bought in January 2023, now you bought at even a larger discount, where the intrinsic value is at 135, but you bought at 123. So now you crossed over and you went up to 166, 255. Now, the place where it comes to be important to understand, like, how far overvalued are we, and do we want to take some of our profits we want to sell, or if we want to do a forecast. So as an example, 176 is quite a bit over intrinsic value. We may want to have sold at that time, because from that point, you're doing a forecast of the company's earnings and the actual price of the company. You say, well, this might be forecasted as a loss because it's going to be really hard for the intrinsic value to get up to 176 that quickly. So from here to 255, it already has gone from 255 at that point down to 208. But if we were still forecast, we have a gap there, 26%. So the time can be on your side. Like, the longer that you can keep it running, the better. But if with that gap, then if it is going to go back to intrinsic value, how many years before this number can catch up with that number? And if it's going to go back to intrinsic value before that time, then you're probably going to have a negative expected rate of return. So it's impossible to know exactly when this is going to happen. The best you can do is kind of understand, like, is this overvalued or undervalued? Should we take some profits? How's the company doing itself? What's a fair value? Sometimes, like, the intrinsic value, maybe some people are going to think it's a lot higher than 154. Maybe it's not just based on the financials. Maybe there's new things coming up that haven't been thought of. But overall, I just wanted to explain the concept of what they were talking about, the two rates of return, is that if you know that you're going to get right around 9% growth from Apple and you're able to buy it at a discount, well, you're actually going to get a higher price return than that 9%. If you're getting 9% growth rate, but you're buying too high, then you're expected to get lower price return. So hopefully this is helpful. This is explained. I can dig a little bit deeper into it, but that was a concept that I thought was interesting in the book and just wanted to explain it.